I really want you to know this. I am not a hypothetical, theoretical kind of person. Every example that I have ever given or will ever give has been either a trade that I have taken, one, lost money on, or I'm actively contemplating in taking because I see XYZ opportunity. And I will explain myself always extremely thoroughly. The reason why I'm opening up with this is because some of us learn some of these techniques, and I've seen it many times. You put on 20, 30, 50, 100, $500,000 worth of risk, and all of a sudden you're seeing a drawdown of 70%. I do not want that to be any of you, okay? So heed my warning even before we jump in. I'm not saying this to scare you. I'm saying this to prepare you. When you are talking about the stock market, it is a sea of sharks. There are literally killers out there that will take your money and won't give it a second thought. Cool? That is how we need to think about what it is we are doing going forward. You have to be mentally strong and prepare yourself for the long game here. You're going to need a lot of energy, and most of you are not going to get it right the first time. I know that I didn't, not even the 10th time did I get it right. It takes mental acuity, and it takes a lot of energy in order for us to really prosper in the market. Cool? Every example that I will ever give you will always be an example that is actively being contemplated or that I have taken. Cool? That is my contract with you. That is a promise that I make to you guys now. So that being said, without me doing my Godfather thing here, let's dive into indicators and let's actually learn something. What you are seeing now is Cool Trader's chart. Now, I know what you all are thinking. There's not enough indicators on this chart. Obviously, I'm totally joking. We're going to take a subtractive approach to this. I wanted to use at least what I would consider the most common indicators that are widely accepted in the market. If your indicator is not on the chart, it's not because I'm dissing it. It's just because I don't have enough room. So let me point out a couple things. Moving averages are here. They're all over the place. There's a stack from 8 all the way up to 200. You have the MACD. You have the volume-weighted MACD. You also have the RSI. You have the ATR, accumulation distribution oscillator. Depending on if you're seeing this on your phone, you can't really get all this. And then we just have the regular old MACD. Now, on top of that, we have what's called the volume profile, the POC. We have the static VWAP. We also have an anchored VWAP that is not showing right now, but you get the picture. There is just way too much information here. Take notice of something. I can sit here and recite the manuscripts and all the little fine-tunings of all the indicators that are on the chart. We can fine-tune this to death. It's not really that advantageous for us to go over the complete manual and know exactly how an RSI or a MACD needs to work. It's quite simple. The RSI, when you swing below the 30 mark, then what you're waiting for is not just because it hits 30, are you taking the signal, right? I've discussed this at length. You want to pay attention to 2 to 4 factors. Generally 3, I think, is a good number. You were oversold on the RSI right here on NVIDIA for the 30-minute time frame. Take notice of that, okay? So 30-minute time frame, you're oversold. So we didn't necessarily break below, right, like we're indicating here on the RSI. But when we're trading back into the 30 level, or the 30 threshold, I should say, that might have been a pretty decent buy signal. Cool? We're not getting a buy signal here off of the volume-weighted, or excuse me, the volume MACD. We're not really getting the strongest and most concise signal off of the ATR. We're not really getting that off of the accumulation distribution oscillator. You guys see what I'm trying to say here? I'm trying to say that if you have too many factors, you have too many wires, too many chefs in the kitchen, you can't get anything done. So let's take the subtractive approach. I'm going to take this volume MACD. I'm just going to take that off. I'm also going to take off this indicator here, and I'm going to get rid of the average true range. So all of a sudden, this starts to become a little bit cleaner. Notice that price action has a lot of stuff going on there too. So there's a whole bunch of moving averages, and I'm not even highlighting all of them. Let me get some of them on there. So we got all this information here, and now I have space for what are known as the volume bars, right? So it's starting to get a little bit cleaner, but I don't know about you guys. This is still a little hard for me to identify a buy or a sell signal. If you guys so choose, we'll remove the moving averages, but we'll put them back on here in a second. So I'm going to take off the volume and I'll take off the stack. I will explain why I use a specific stack in a little bit. Let's remove all that. So I have right now a corridor, and then I have the accumulation bands, which is another indicator. And as you can see, I have the Bollinger Bands here as well. We're getting a cleaner chart. The reason why we would recommend, or I specifically would recommend having a cleaner chart like this is just because you want your indicators to basically be telling you the same thing. If you're using indicators that don't really have the same variables as inputs. At least they're not close to being the same variables. What happens? You're going to get caught in the crosshairs. What is your first level of technical analysis? As we go through the pyramid here, I just want to refer back to, first, let's level the playing field. Let's get out of the 30-minute time frame, which I know all of us are very comfortable with because a lot of us like to scalp. But let's go here to the daily time frame. Already looking at this, we can identify a trend. I drew a trend line right here. That was me. We have this funky thing that is known as a volume profile. I will explain why it is on my chart, but lo and behold, it kind of looks like we had a trend line jump right around here. And I actually did take this trade. I didn't take the trade off the trend line per se, and I did not use the MACD, which looking like a pretty decent signal there on that cross line. Also on your RSI, we were coming into oversold territory, but I didn't take it just because it hit 35. I want you guys to notice what I'm trying to convey. It's not one thing. It's a multitude of different things. Do I know off the daily time frame that I'm taking an entry off of 116? Of course, I don't know that. I need to jump into the lower time frames, but on the higher time frames, I'm building the context. How do I build context? Let's remove all of that. Let's remove this, and we're just going to go back to basics. You're going to see how I do this, not only on NVIDIA, but on a million different other things. That is one thing that I know I can do very well. I can analyze things to death. So let's check this out. When we're doing supply and demand, we want the strongest pivot points. So there is an indicator literally called pivot points. Some of them are going to outline this for you, but I just want to be as most common sense as I can. Common sense tells me that $75 seems like a pretty good area. But Sage, you said 2 to 3 touches and then, you take the trade. Yeah, 2 to 3 touches is a principle. It doesn't mean that it's always going to happen. What other principle do you see here? I actually see a higher low there, and I also see a higher low there. Check that out. So 2 to 3 higher lows, and then you take the trade. Guess who took this trade long when we were starting to break there to the upside? This is one of the trades that I took on NVIDIA. I've taken 26 trades on NVIDIA in the last 9 months. This was one of them. So going forward, how did I know that I wanted to take this trade? It always comes back down to this every single time. I'm setting my stop loss accordingly, and then I'm taking it to realistically the first resistance point. Does everyone notice that number? That number is a 2.2 to 1. Cool? Awesome. And we're not even using RSI or MACD. So cool. We already understand that. But Sage, looking back in time, seems pretty simple. Yes, it does seem pretty simple. At the time, I was using my moving averages, which you will see here in a bit. Why I took that long signal was basically off of the cross on the shorter term moving averages. The stack that I prefer, I'm not saying that it is the best stack, but the stack that I like for the short term is going to be the 8, the 13, the 21, and also the 34. You can add the 50 on there as well. That's a lot of stacks, but I generally like to use 3. I like to use the 8 and also the 13 for short-term momentum, but generally I'm using the 8 overcoming the 21. You'll see exactly what that means here in a second after I go through supply and demand. So what does supply and demand dictate for me now? Did I know that we were going to come into a resistance area on NVIDIA close to 140? Of course I did not. I had no idea. Do you ever know where the top is on any particular stock? This is where my trading system and my psychology, this is one of the things that I have recognized for myself that I cannot identify. I cannot identify what a top is. If we are breaking to the upside, just look at this on the weekly. If we are breaking to the upside, this is where I fundamentally believe in the efficient market hypothesis. Stocks and ETFs, more particularly ETFs, are designed to go up and not have a ceiling. That's why I like up trades, or I like long trades, more technically speaking, more than anything else. I like buying dips. I like buying low. I like buying at discounts. And then I also like riding the trade. You will very, very rarely see me trying to short a fresh all-time high. It almost never happens. I can count on 2 hands how many times I've done it in my career because it is designed to keep on pushing forward. Cool? I understand that. It has nothing to do with stocks, has nothing to do with indicators, has nothing to do with what you're seeing on the chart. It has everything to do with how I understand the stock market outside of technical analysis. So I've taken the liberty here off the 4-hour time frame to literally point out where these support levels are. So some of you are going to say, hey, you have a support here, you have one here, you have one there, you have one there. That's fine. That's actually okay. I'm not opposed to that at all. I like to have on my chart between 2 to 4. So let's outline that here. 2 to 4. And we're doing basic stuff here, guys. It really is really, really basic. So I'm going to bring that down a little bit lower. I'm going to get rid of that. I'll get rid of that concrete level. And let's just go through this. Boom. Boom. I'm going to explain why I'm setting these levels here in a second. So right now I have 3. How did I know that this is going to be one of the pivot points where I did take a long? I took a long at 119. How did I know that? Well, I have context right about here. I want to zoom in on the 30-minute time frame because this is where you guys can appreciate this a little bit better. If you're coming into this without me knowing that this was going to dip below, right? It dipped all the way down to 113. I didn't know it was going to dip down to 1. I had no idea. No, you'll hear me say this all the time. I have no idea what's going to be going on in the market, but I do know that I recognize some form of a corridor, and then we broke the structure of the corridor. How did I know that I wanted to take that long? Check this out. It's all about principles. It's all about that second layer of the pyramid. We put in a low, and then we have a higher low right here, and then we push for the third higher low. Where do you think I took this trade? I'm going to tell you where I took the trade. I took it right there at 119. How did I know that I was going to take that trade and it was going to move up to 138? No idea. No idea. This is why I tell you guys, and the way that I teach is do not go into the market with a concrete absolute bias. You are going to be hurt, as I have been, because I used to be very, very strictly biased, strictly long, strictly short. I fundamentally am more of a long trader, and I let price action develop as time goes by. But for the shorter time frames, for 30-minute, for 15-minute, for 10-minute time frame, this is how I apply my mental capacity for everything I do. I took this trade, and then I'm adhering at least to 2 to 1. So my stop loss was a little bit higher, it's about 117. And then I'm looking to take that at least up to about, I said at the time, 122, maybe 125. That's a 2.5 to 1. Cool, I'm good with that. So I actually held on to the trade. I made almost, I think it was 97% on this trade. So I took this off when this was breaking above like 136. The rest is history. If you are taking this with shares, it's the same principle. If you're taking this, you can't do it with futures, but if you're doing this with calls, you probably want to do 30, maybe 45 days out. This is how you apply this. We'll have our whole other section talking about options trades, but I just want to fundamentally talk about one-to-one relationships here. This is very easy. We're not talking about intrinsic or extrinsic value. We're strictly talking about price action. So Sage, how do I know that we weren't going to start breaking lower? You don't know. You don't know. What is the risk reward to the upside? Let's be realistic now. Let's not think that we're going to take that up to 147. The realistic target that I would have had for this to the upside, realistically speaking, 126. That is a 5.5 to 1. All that we have discussed up until this point, I have not broken any of the rules that we've talked about, not a single one. So high or low, looking for 1, looking for 2. You can maybe consider that 3. It's subjective, but I think we can all agree that there's 2 there, and then you fire on all cylinders. If we start breaking lower, you adhere to the stop loss, and guess what? We're running into the third part of the principles for pyramid or layer number 2. That's going to be 2 to 3 touches. What happens if we come back down into this area? Let's just say we touch 113. I'm just going to watch it there. Just going to say, okay, we hit 113. What are we going to do off here? Are we going to break lower, right? Am I anticipating us breaking lower, or is there maybe some moving averages that might be pointing me to the upside? This is where indicators start to become very handy. Let's introduce those here. I'm going to get rid of the RSI, and I'm going to get rid of the MACD after I get through this explanation. But check this out. You got a MACD signal about there. Does that line up pretty well with the signal? I think it does. Does that line up pretty well with the signal on the 30 threshold for RSI? I think it does. So does the RSI and the MACD work for 30-minute, 1-hour time frame? A lot of people trade this way. There's no problem with this at all. Know where your triggers are, right? I'm not going to tell you stop using RSI and stop using MACD. That would be silly for me to do. I am telling you that if you are going to take the trade, make sure that you are reading what's going on here and what's going on here, and they coincide, right? Make sure that there is, without a shadow of a doubt, the signal is the same. Either if you're looking on a histogram or an oscillator and with price action. If you are seeing that you are more oversold on the RSI and MACD, then we're talking about a good risk reward trade. Would you have taken the trade on this first bounce? I probably would have not. I would have taken this trade right here, but I did not do that because there was extenuating circumstances in the market that I knew I wanted to wait a little bit more. So that was a nice jump there. Would that have been a trigger for you to take a long? Absolutely. Absolutely. So in my opinion, you have 2 signals on this chart, and I'm going to point them out to you. The first signal would be right here. you wouldn't have caught the bottom perfectly. You would have probably been in right about there. I didn't even mention the Bollinger Band. Forget the Bollinger Band. I don't even want to talk about the Bollinger Band right now. So we'll get rid of that, and then we'll see Bollinger Band is right here. So we'll get rid of that. And then we'll also get rid of the accumulation band. So we're just strictly looking at price action. That is an entry, and that is most definitely an entry. What did we go for here? This is more an advanced concept, but you guys are big boys and girls, man. You went for a liquidity grab back down here lower. And how do you know you were going to be jumping off that area? You never know. You never know. But you do know that you did touch that area, and then you're waiting for that second and third touch. You see, we have two principles that are working out here. You have the first, the base, you have the second higher low, which is going to be right there. And then you have the third higher low, which is going to be the trigger. So you have those principles that are working in tandem. And then on the 10-minute time frame, let's just check that out. Let's remove the MACD and let's remove the RSI because I think you guys get it. And let's just look at the moving averages that I myself am using. Let's use the 8 and let's use the 21. We'll just leave it at that for right now. Do I have a signal as a buy or sell? Just think about the moving averages very similarly to how it is you are going to use the MACD. Do you have a signal here? Do you have a signal here? Do you have a signal here, here, and here? I can argue that you have probably 7 to 8 signals. I want to point all of them out. The first one is here. I'm not going to give you the answer until I'm done with the circles. You have another signal here for a buy. Some of you are saying, hey, I can identify some sell signals there too. Great. Then you're starting to get it. Then I have a buy signal approximately there. Then I have another buy signal, let's say approximately here. Looking back in time, it's very easy to point them out, right? I don't really care about what happened back in time. I care about what's it going to do after the most freshest candle. How do I know which one to pay attention to and which one I can probably ignore? Principles. What is the demand level? You got one here. Got a pretty decent one there. What is the demand level below that? You created another demand level. Remember what I said? I usually say I have 2 to 4. How do I know that 113 is a demand? Well, you got to give it context. Back into the 4-hour time frame, where is that context? Well, that context was there, was it not? Can I not convince you that that is a support level? You have one both at 115, and then you also have one approximately where we bounced off from, 113. You see how that works? You see why it is I have more than one demand level, and I definitely had one here. I knew that I was gonna take some positions if we started breaking below 105 because the risk reward would have been unbelievable to the upside. It would have been great. I already took a sizable position here, not that big, but it was pretty good. Okay, it was really, really good. So what am I looking at here? If I were to take shares and set the appropriate stop loss, I'm probably looking at realistically a 9-to-1 risk reward. That's it. We don't have too many fancy indicators on here. So now let's look at where the buy signals are. Let's check it out on the 10-minute time frame. Do you see what we got going on here? Would I have taken this first trade? No. So let's get rid of it. Would I have taken the second trade? Probably. I probably would. Would I have taken this trade right here? This is the trade that I was discussing that I did take. So that's going to nullify that, and that's going to nullify that. Why am I taking it approximately there? Some of you are going to say, Sage, that's the second touch. You got in a little too early. You're right. You're absolutely right. So some of you are going to say, I'm going to wait for the third touch. That's part of my system, and that's what I want to wait for. Perfect. Either the second or third touch for me is perfectly fine. You're giving a little bit of the upside, but check that out. Who cares if you're catching a decent enough move? Does it really matter if you're making 80 or 90% at the tail end of this? Some of you might argue and say, yeah, that 10% is really gonna set the bottom line. That's fine. That's totally fine. Do you know the statistics on that higher low for the second touch and the third touch? That's what I'm more interested in. So you're coming into the demand level. You hit that third touch and then you fire off. Do we know that that's going to happen every single time? No, we don't know. How are we going to give this broader context? We're always going to use the 10-minute time frame, and we're going to bounce that off, maybe the 1 hour, maybe as high as the 2 hour. You don't want to go too far because then you lose a lot of the sense of where the context is for, time frames that are analogous to one another. You're not going to use the 1 minute time frame and the daily time frame to make trading decisions. If you're going to take a trigger off the 1 minute, you probably want to use for context the 30. If you're going to take a trade off the 4 hour time frame, go as low as the 30 minute or maybe 1 hour and see where it is those contexts can start being built off of the time frames that actually do make sense for you to commingle with. So what do we got going on here? I think that this is a fairly obvious demand level. I really do think it is. Hopefully, I'm doing a good enough job in explaining why that is so. This is foundational. This is, I mean, you have to know this, especially with how it is I teach this. You're not going to come into this demand level and you're going to hit it perfectly every time. We didn't do that here. We got all the way down to 113. It's all about you looking and recognizing the zone to start off, and then you fire on the trigger. Where is that trigger to start off? You have an unbelievably clear trigger, unbelievably clear at 119. It is unbelievably obvious. I use that word 4, 5, 10 times. Why is it obvious? Because the 8 is overcoming the 21. You can use the 13. You can use the 24. You can use the 19. It doesn't matter what moving average is. For the system that I'm showing you, if you want to modify these moving averages, that's okay. If you want to use the 5 and the 13, 5 and the 12, all good. What I'm trying to convey is that if I'm using the 8, the 13, and the 21, which in this case, I don't have the 21 on here, but let's throw on the 34. If I want to take this trigger, it is going to be off of that signal every time. Every single time, it will be exactly this. If this trade does not go in my favor, my risk reward, I already know how to do this, so I don't have to put it on every single chart. But I'm going to take that to where this is at least a 2 to 1. In this case, it's a 3 to 1. I'm going to take the trade every time. Every single time this will be the case. Now let's do this here for the short end, right? I generally am not shorting the market on a fresh all-time high. I don't like to do that, but I do like to pay attention into supply areas. So let's use that same principle using just the moving averages. We haven't talked about any other indicators, no volume profile. I haven't even mentioned that stuff, but let's check that out. So supply area, I think we all can come in and agree that that is a pretty clear supply area. Why is that? Because we've touched that area 1, 2, 3, 4, 5, 6, 7, almost 8, 9, 10, 11 times. So are we gearing up to breaking that top? Well, let's analyze this a little bit more. Let's check out the 4-hour time frame. Do we have consistently higher lows? Well, you can argue that on the 4-hour and the daily time frame, there's a pretty clear trend here. I think that we do have some consistent higher lows. It really depends on how far you want to go back. If you want to just use the 30-minute time frame, maybe not. Maybe we don't have so much going on there. Now, if you want to use the 1 hour, the 2 hour, 4 hour time frame, maybe it's a little bit more apparent. I can probably guess that most of you are going to say, hey, we're going to come up into 145 and I'm going to be taking a long right here. If you're going to be trading the way that I'm trying to teach you, you're not going to be taking a long here. You're already way too late to the signal. You're way too late. Way too late. I prefer that if you are going to take a long trade, you at least consider the risk reward to the upside versus the downside. Check this out. I really want to make sure that I do a good job here. If I take a long trade, even if I'm setting it to, let's say, at least 2 to 1, the upside on this is a 4.5 to 1. Cool. I don't particularly know where we're going to be going on NVIDIA, but the downside to this, just check that out. Let's modify this and let's set the proper risk reward. The downside is almost 3 points more if we were to take a downside trade. So what I'm saying is I see better risk reward to the downside. Now, some of you are thinking that doesn't look like a downside trade to me. That looks like all the momentum is to the upside. I don't disagree. I don't disagree whatsoever. But I'm telling you that the risk reward is better to the downside. Hopefully I can convince you of that. So am I going to take a downside trade here? Well, my moving averages are not really giving me that signal. So now let's actually talk about the downside trade. Let's talk about looking back in time. It's obvious. It's obvious. Okay, I got a cross here and this sold off 17% because NVIDIA was now going to be overcome by DeepSeek. All right, that's obvious. What about this one? That's kind of obvious too. This seems like that price action kind of followed through. You got your signal probably at, let's say, $144. I think that's a reasonable signal. I think we have not such a good signal here for a short, but we have a fairly decent signal here. Let me remove the 34 so we can clean that chart up a bit. That's a pretty decent signal there. That's a pretty decent signal there. It's very similar to how the MACD works. We have a pretty decent signal here. We have a pretty decent signal right there. That's when the 8 is now not overcoming, but it's being overshadowed by the 21. Does everyone see that? When you're looking to short the market, you just want to make sure that as you're coming up into this area, the same thing that we discussed here, you just want to make sure that the risk reward is even worth your time. I am generally shorting the market 30% of the time. I've already explained as to why. Fundamentally, I see the market trending up over the long haul. This is why I do more long-term trading. Notice that I am explaining to you my psychology. why I like to take trades the way that I take them, why I'm sitting in trades for a little bit more time, because I've recognized with myself, time is going to go by anyway. The market is designed to go up anyway. Why don't we take some long trades, wait for those pockets, and wait for that trade to come to you? That's what I want you to understand about any trading system. It's not necessarily about I'm going to catch a short position on NVIDIA and I made $25,000 off $1,000 with the short here when it drops 17%. That's great. That really, really is phenomenal. But how repeatable is that process? For me, I like the statistics with trading off the 1 hour, the 4 hour time frame, and everything in between for longer term trading, especially trading to the upside. Cool. So we've gone over the moving averages and we did a lot of subtractive technical analysis. I want to give you guys a break here, and we're going to just make sure that we can capitalize on what we've learned so far, and then we will continue here in just a second with more examples. All right, now things are getting interesting. You're seeing more colorful charts. You're seeing things that maybe you haven't seen before. A lot of you are already working with moving averages, but it's not about the 8, the 12, the 21, the 34, the 60, the 9. It's not about the moving averages per se. It's about me identifying when I'm crossing on this moving average, are we doing it close to a demand level? If that demand level is hitting, how many touches do we have in that area? And I haven't even begun talking about volume. I haven't even begun talking about the oscillators. I haven't even begun talking about the volume profile. So you can see how this becomes very complicated, especially for you newer traders. Some of you are being taught where you need all this information, but they're not really lining up and giving you definitive answers. I'm not saying that that definitive buy or sell signal is going to work out every single time. This is where you have to work on your psychology. You have to work on accepting the fact that if you are wrong, even taking the signals that I'm sharing with you here, you're going to be fine. Why? Because you are adhering to risk reward and you are taking charge of, if you take the signal and all of a sudden it just doesn't go in your favor, you at least know, okay, I'm willing to risk 5, maybe 10% of the position. If I get it wrong, I can take the re-entry on what Sage is telling me. I have a re-entry with a demand level that is pretty apparent. It's based on anchoring bias, no question that it is. But we're not going to take the trade just because it hits the demand level. You have to understand that. You're going to look at the trade and just pay attention to it. Then you're going to fire off an alert, which we haven't discussed, but I would recommend you start using alerts. You fire off that alert, and as soon as you see that oscillation or that pendulum starting to swing in the other direction, this is on you on picking good quality stocks. If you're going to take something where it doesn't really have a lot of momentum to it, then you can't really expect much. But if you are looking at good quality stocks, the demand levels, especially if you give it enough time, they will become a self-fulfilling prophecy. They will start to undulate and they will start to move in the upward direction. It happens on the best 50, 75, 100 stocks that exist in the market. You got to know that. The chart is not going to tell you that. All that homework that you do on the back end, all that reading and all that preparation that I know you guys are doing now following this trading system. If you understand how markets move, especially in long terms, and we're not talking about that long term, we're talking in a span of like 3, maybe 4 months, you can capitalize on those moves. All right, now let's get back to additional trading indicators and me explaining how I use them together on a different chart aside from NVIDIA. What you are now looking at is Adobe off the daily time frame. Let me just have my moment here real quick. I bought into Adobe for mid 2015. This is it off the weekly time frame. I bought this at $78. All the principles that I'm discussing, I've been using for literally years, okay? So I noticed that we had a dip here on Adobe and I caught right when we were looking to break those all-time highs, and I held for a very long time. I held these shares for more than 7 years. So of course, I wanted to hold it for longer than a year, so my capital gains wasn't going to kill me or crush me. But looking back on this, did I know we were going to go up to $700? Of course I did not. I had no idea. All I want is a piece of the pie, not the whole thing. We don't know how high we're ever going to take something. Just know this, the risk reward was always good. Efficient market hypothesis, that's my little nugget to you guys here. Let's go to a usable time frame. Let's check out the daily. I have recently signaled and taken 2 Adobe trades. I have taken one here at 420, and I also took one at 440. I will explain them. I don't want to go over to that part of the chart quite yet because I want you to recognize and identify what's going on right here. Let's just look at some demand levels. Let's do this pretty quickly. You have a demand level here. You don't want to go too wide on your demand. You don't want to do something like this. This doesn't really make too much sense. But you do a decent demand level, and what do we have? We're hopscotching here. We have 1, 2, 3 touches, but some of you are catching on pretty quickly. I can hear it through the camera. You guys are saying, hey, Sage, I'm identifying another higher low right there. That's pretty good. You guys are getting it. Then we have a third higher low. Is it clean? That's pretty clean. I would say it's pretty clean. So where am I looking to take this trade? Sage, I'm already starting to get it. I don't even need to look at the moving averages, and I already know by what you're teaching, probably going to take that trade about there. You're right. I more than likely will signal that trade. But some of you are thinking, and this sometimes, I get myself in trouble with this as well. But Sage, I would have been stopped out right there, coming back down into this level, and I don't think that trade would have worked out. That's not how you have to think about this. You have to pull the trigger when you see the second layer of the pyramid and the third layer of the pyramid. When they're coinciding with one another, that is your trigger every single time. If I am looking at this from a risk-reward perspective, which I will always be doing, where am I going to set the stop loss? I'm probably going to set it basically where we started jumping from. What is the risk reward realistically to the upside? I'm going to take that to the first resistance point. Remember, we don't have any idea what's going on here. We'll talk about these trades in just a second, but notice on the daily time frame, it's always going to be the same analysis. I had no idea that was going to be a resistance point, but here we have some resistance and we definitely have some resistance there. So my first point, if you guys can see that first point is a 4.1 risk reward, already pretty good. We want to adhere to at least a 2-to-1. So a 2-to-1 takes me at about there. I didn't even have a sell signal when I was getting up into this area for that trade. So more than likely I would have held on to it. I will tell you now that I would trail up that stop loss and I would have been stopped out here. More than likely that would have happened. But my target area would have taken me there because it is the most recent resistance level. Does everyone see how that works? And then we have also something to adhere to. This is an anchoring bias. That would have taken me to a 9-to-1. If you would have bought this with shares, if you would have told me, hey, I'm looking at this position and I'm going to hold on to it no matter if we start breaking lower here, that is bad trading etiquette. You would have been swept out on your stop loss if you're trading how it is I'm showing you. What you would do, however, is reapply the trade when you were putting in at least the second or third higher low in this situation. You can consider that a higher low. You can also consider that. You can consider that the third or fourth touch, right? We can have an argument or a debate about that. But you would re-enter at these specific points. I'm going to share with you them right now. That's one. The second one is going to be here. And then the third point is going to be approximately right there. So in this instance, why do you think I always tell you guys you should have more than one demand level? And it's okay to take off the trade and then reapply the trade if you feel that you are coming into danger. Some of you guys have no idea that traders are even doing this. It is okay to say, I don't want to be in danger. I don't want to risk another drawdown because this stock is looking a little shady. That is fine. As long as you are adhering to the principles that I repeatedly go over, right? Without question, I'm going to repeat this 100 million times. As long as that number is 2-to-1, you can always reapply the trade. It's okay to take two losses that are relatively small and then jump in on the trade because guess what? Adobe is a pretty good quality stock. Check this out on the weekly time frame. If you were adhering to some of the stuff that we are discussing, look at all the upside that you could have seen. Does everyone see what I'm trying to get at? Let's go back here to daily. What is that upside that you could have potentially seen on Adobe had you held on to the trade with shares or maybe even with options? I'm not even talking about options right now, just with straight up shares. Pretty good risk reward. Pretty good risk reward. Cool. So that other entry, the third entry that I would have taken personally would have been the same thing. I would have given up just a little tiny bit of the upside, but I would have been sure that if I'm getting a trigger here, then okay, I can still be stopped out on the trade. I can try maybe a fourth, fifth time. That's okay. At least I'm not going or holding on to a drawdown of 20, 30, 40, 50, 60, 70%, whatever the case may be. Applying this thought into your trading decisions, this has nothing to do with indicators. I'm not even talking about indicators. I'm strictly talking about reading price action. You're going to be okay with trading, right? Make sure that that upside is even worth it for you. If you are saying, hey, I can probably take that to all-time highs on this really good quality stock, you're starting to think the way that I think. Let's just say I want to hold out for something like that. Then this is what I was discussing before on going for a 10, 15, 20 RR. It totally happens. You're not going to say, hey, those trades are few and far between. Of course they're not. If you just apply some of the stuff that we're discussing, we're just at the second layer of the pyramid. We're not even overcomplicating the process. This is enough. It really, really is enough. Now let's go over the trades that I actually took. I'm going to tell you now that at the time, I did not take these trades on Adobe. I wasn't paying attention, or for some reason or another, I was trading different things. Let me share with you what it is that I actually am trading. I'm going to go off the 1 hour time frame. Some of you are going to identify this without giving you a table. That is an inverse head and shoulders pattern. You have a left shoulder here, you have the head, and then you have the right shoulder. I took this at 2 points, literally 2 points. I took this first off the signal here when the head was starting to take shape. Why do you think I took it there? You're probably already identifying. The 8 overcame the 21. It don't change. It's going to be the same thing every time. And then right here when we were coming and we were overcoming 440, I took this at 440. I didn't take that at the bottom of the candle. When I noticed the signal there at 440, crossing that and looking to break above this resistance, this is a little bit more conceptualized, but you guys get the idea. Right there, that cross signal, boom, I took it there. So I took here almost a 100% trade on this. Check out the risk reward. If you were to take this with shares, even with options do decay. We will discuss that in later videos. We should just be learning about stock trading to start off like this because the same principles apply to options. I'm going to take that first off, maybe about there. What is that? Let's move the stop loss to something that's a little bit more realistic. My realistic stop loss would have been there. That's a 4 to 1. Cool. So I rode this up and I took this off recently. I took that off at maybe about, I think I took it off at 444. So let's bring that down to 444. So 444 puts us down about there, but check out the risk reward. It's 5 to 1. And then what is my risk reward for the trade here? Where do you think I'm going to set the stop loss? Probably going to set it at where that candle started taking off. So I'm setting it at this resistance zone here because that's the previous resistance. Let's actually move that up a little higher. We're looking at another 4.4 to 1. That's it. Ain't that complicated. It really is not that complicated. So how many things did I identify here as points of interest? I first identified a demand level. So that demand level, let's just call that out right here. Do I have context on the higher time frame for that demand? I don't think I do. So was that really a strong demand level for me to go off of? Some of you might argue, Sage, I see the demand level right here. That is a nice little launching point. I don't think it was that very strong. So when you can't define a good demand level or a good supply level, then you need to go back into the 4 hour time frame and you need to make some tough decisions for sure. Did I know that we were going to bounce off 407? No, but I was looking at I would say 435 pretty closely because I said we come down into that level and we go for a liquidity grab. Maybe I want to be paying attention. I took that trade a tiny little bit early, just a tiny little bit, but I was aware of the risks and I was willing to invalidate the trade, taking it off if I was going for a 5-10% stop loss, whatever. Same thing here, did the same thing. So now this is a new demand level, is it not? So we have created one. Stop thinking that your demand level is always going to be clear as day. It's always going to be difficult. It's like hunting for a needle in a haystack, literally. We put in a new one. Wait. And then we're looking for a higher low, which is what I did. 10-minute time frame. Did we get that higher low? Let me see. We're all the way back here. We put in a platform. We have a higher low there. And then we're looking at some momentum there to the upside. So I took it off the first touch. Was I risking it? Yeah, of course. Of course I was risking it, but I was willing to risk it if my risk reward was worth it. I think it definitely was here. What happens when this goes wrong? It's simple. It really, really is simple. If this starts going wrong, you take it off of maybe that, let's say arbitrarily speaking, you took it off 416. You have to be mature enough in order to say, hey, I'm taking it off of 416. My risk reward is there at 440. I'm not going to be moving in my stop loss. Remember, I said just a couple of videos ago that this is one of the biggest problems that traders sometimes can't face. Don't move the stop loss. Make sure if you're using the tool, it's at least 2 to 1. Cool. That's my example here on Adobe. We're going to do plenty of other examples going forward. Notice something. I do a lot of examples and I'm pretty thorough, and I understand that these videos are long, but applying all of this thought and all this energy into every trading decision you will make, you will start to build some muscle memory. It's all progressive overload, right? Progressive overload, same principle that we're using here. If you go to the gym, you understand what I'm talking about. You want to start off with the hard stuff, and then the hard stuff starts to become a little bit easier because you are leveling up. That's what we want. Let's move on to the next example. Up until this very moment, we've actually gone over quite a few examples. You may have noticed this, but I go in depth with a lot of examples that I give. Sometimes I take 10, 15, 20, maybe even 30 minutes just to delve into one stock. Now, going forward, That's not always going to be the case. Generally, when I'm doing technical analysis, especially during a live session, I maybe take 2 to 3 minutes, maybe up till 5 minutes to do the analysis, but it doesn't generally need to take too long. You just have to know what to look for. Now, the reason why I generally have 3, sometimes 4 demand levels on any given time frame, it's not because I'm just using the indicators for me to tell what is a buy or what is a sell signal. Think about this not in just 2 dimensions, but now 3 or possibly even 4. Where you set your demand levels are re-entry points just in case you get it wrong the first time. This happens to me. It actually happened to me today with a trade that I took on Google. This is the second time that I tried to enter on Google. The first loss, I took a 3% loss, and then the second one, I cut it for break even because the structure wasn't there any longer. Use the indicators not just to tell you when the buy or the sell signal is, but the potential for you seeing an entry later down the road just in case you're wrong, right? Because we're never wrong as traders. That's how I want you to start looking at everything that you're learning here. It's not just about always being right, but when you are wrong, what are you going to do about it? So without further ado, let's continue on to the additional indicators. You've already learned about the moving averages, the supply and demand areas. Let's go a step further. What you are seeing on your chart is Apple on the daily time frame. This is literally the best possible example I can give you because I recently took a substantial trade on Apple. And after this video, which I know is going to be on the longer side, but if you stick with it, everything that I'm going to explain in this video is going to very clearly explain why I made such a critical decision based off of risk reward and based on some things that sometimes are not so obvious on the chart to take a trade the way that I did. Cool. So that is my promise to you. If you stick with it, you will learn something just watching this one video alone. Let's go back to some of the principles. We're not going to spend too much time on them because I know that you guys are already starting to get this. Notice that I only have 2 moving averages on my chart, but we will populate the chart with more moving averages here very shortly. I have the 1 demand level. If you did not know this about the stock market or just generally how I think, you can probably guess that I'm more on the spectrum of being an optimistic trader as opposed to a pessimistic one. Why is this important? Because it deals everything with math psychology. The pessimistic traders are going to be the bears. The optimistic traders are going to be myself. We're going to be the bulls in the market. So when I'm looking at something like this, fundamentally, I already understand the statistics on the pullbacks. Mainly the most important stocks in the market. Apple is going to be right there, top 5. Also on the ETFs. Just think about this. Without us going over the volume profile or the volume, which you will learn in this video after I get done with this one example, you're going to see how I use those in tandem with one another to confirm the supply and demand and to confirm the signal that you want to take for a buy or a sell. So let's do SPY here real quick. Let's just generally say this has been trending. We know that this has a long-term trend, and that's what it's supposed to do because it's going to follow the efficient market hypothesis. Let's just generally say that if we have a 10% pullback on SPY, just check this out, man. This is really, really cool. When I learned this for the first time, I'm like, okay, now I know what kind of trader I want to be. If we do have a 10% pullback, some of us are thinking we're not going to be seeing a 10% pullback. Get out of that habit. I'm telling you now. Do not ever think that something cannot happen in the market, whether to the upside or to the downside, but generally to the downside. You can always sell off more, right? Always. I can prove that point to you time and time again. If you pull back to that 10% level, if you are doing what it is I'm recommending for you to do, not just have the 1 demand level that is the closest touch point, right? Because most of you are going to say, hey, I got a demand here, and it's definitely going to hit 600 and bounce off that level, right? Because that's what always happens. Nope, wrong. You have to set more than 1. So in this situation, I'm actually going to set several. I have one there. I have one there. I definitely have one here. And just that 10% pullback on SPY, I know for my experience from doing this for a little while, we get back down to that area, I am going to be slapping on that position. I'm going to be putting so much money, basically going to put all my money in the ETF, right? This for me is such an obvious trade that I dream about these trades day in and day out. I'm not even exaggerating when it comes to this. So if you understand statistically, when you pull back 2 to 4, 4 to 6, 6 to 9, 9 to 12, and then you start exaggerating here a little bit, but anywhere between 12 to 15% pullbacks on some of these major stocks, NVIDIA, AMD, Walmart even, Costco. When you start pulling back on these major stocks, then the supply and demand level is usually all it is you need to see. On top of that, you're going to add the moving averages, and that's where it is you're starting to make some pretty critical decisions. I'm going to be clear with you, man. On the Apple trade, I took more than a six-figure trade. Now, I set the right risk rewards, and you guys are going to understand why I did that and why I was confident to do it. Because even if I do take the trade, and let's say I take a 5 or maybe even 10% stop loss, that means that Apple needs to sell off another 10%. I'm okay with losing 10 grand. That's fine. Because I know that if I set that stop loss, at least adhering to 2-to-1, that I'm going to be making that $10,000 back. Not because I know that the market is going to be recovering in the next 2 weeks, but I know eventually that is what's going to happen. So this is the thing that sometimes we don't discuss as a trader because we're only looking on the shorter time frames. I have the utmost confidence in my trading because I understand some of the concepts that I'm now yelling at you at. So if we're going to set certain demand levels, this is exaggerating the point. I'm literally exaggerating the point. But coming back to the Apple scenario, when we came back to 220, did I have with 100% certainty know that we were going to bounce off the $220 level? Let me spare you the suspense. I took this off of 220. No, I did not. And did I have more than one demand level? You betcha I did. Because if I'm teaching you this is how I trade, you better believe that I'm going to be using these strategies, and I have been for 15 years. So I have a demand level there, and you can argue that there is an interim demand level approximately here because you had a violent reaction off that point. Later on, when I teach you about the voodoo lines, you're going to see how I use a third level of confirmation off of supply and demand. Because if I'm going to put $100,000 down on something, $1 million, $10 million, $1 billion down on something, I want to be pretty sure. I don't want to just go off of one moving average or just one silly candle and make a huge decision like that. I know you guys feel me on this one. So as we came back down into this level, how did I know that I wanted to put on a big position here? Well, now this is where we talk about the additional levels of confirmation. They're not going to be triggers in and of themselves. That would be ridiculous. You need to have 2 to 3 layers, and then from there, you're going to use 2 different confirmations. I shared with you guys that on the Adobe example. I'm going to do the same thing here on Apple. Are you going to be taking an entry off of the daily time frame? Most of you are going to say no, and I agree with you on that. I want to make sure that I'm transparent here. The last time that I took a trade on Apple, because I generally don't trade Apple unless it pulls back into some really interesting areas, without exaggerating at all, I took this at 165 the last time we were here because we did have a significant pullback. Everything that I've taught you so far about identifying the buy signal off of the moving averages and off the TTM, that is what I've used for pretty much 95% or if not 99% of the trades that I've taken. Am I going to take this off the weekly time frame? If I would have taken the signal here, I would have been late to the trade. If you guys are long-term investors or you usually are holding on to positions for 6, 8, 10, 12 months or longer, then you can use the weekly. But most of you are not interested in that. And quite frankly, I'm not either. So just as the weekly time frame, I want you to just see the context of the 175 area. I took it at 167 at the time. Let's go back here to the 4-hour, and then I'll talk about the trade that I actually took here as well. Let's go back a little bit further. Why is it that you think I took it off of 165 or 167? Let's just look at this, right? Everything that I've taught you so far is going to line up quite well here. You don't have the context of the demand, so I need to pull back even further on the daily time frame. But there it is. If you can spot that demand level, most of you already can because you have a lot more intuition and you're learning a lot quicker than I was, because back in the day, we didn't have the same information and the same education that you guys are getting. I wish I did. So I have that demand level approximately there, but it wasn't going to be my only demand level. Forget all this stuff, right? That stuff doesn't exist. I had no idea that that was going to be happening. And then I had another demand level on Apple approximately there. So I knew that as we were hitting that double top, I saw the rejection, but I was noticing exactly what the percentage of the pullback might be. Those are just things that I'm usually paying attention to. If we're pulling back more than 10% on Apple, I don't even need to look at the demand level. I already know that the buy the dippers or the institutional traders are starting to think, hey, we're going to start building some positions on Apple. It doesn't necessarily mean that it's going to work like clockwork. That is not what I'm conveying to you. What I'm conveying to you is this. You have to have the demand level set, and it's just going to be the initial point of contact that just sparks your interest. What is going to actually be the trigger is going to be the moving averages and some sort of oscillator, RSI, MACD, TTM, whatever the case may be. Accumulation, distribution, doesn't matter. You just got to make sure that if you are going to use triggers, try to at least use 2 to maybe 3 for those of you that want that additional level of confirmation. So now let's go back. Why did I take that trade at 165? Just check this out. It's really quite simple. What are the moving averages telling you on the daily time frame? It's telling you that approximately 168, 169, that was the buy. It was literally the buy. And what do you have down here? I've already outlined it for you. You were starting to squeeze into that zone. So it's not that I knew that 165 is going to be the bottom. I didn't know. But I'm thinking about this probabilistically. I'm thinking and using every single time, every single trade, every example, every 30-minute, 45-minute, hour video that I make explaining just one stock is always going to come back down to this. If I'm taking this with shares, I'm probably going to set, realistically, I'm going to tell you now, I'm going to set about a 5% stop loss. So that means that I at least want to take this to 10%. So if I'm using my previous resistance point is all the way up to 195, right? Because that's what my all-time high is. If I'm going to take that trade, my stop loss more than likely is going to be set a little bit higher, because if I have a break of structure, I don't need to wait for that 5% or that 10% drop. Why do I need to do that? I don't need to do that. Wait for the structure here, and I don't know if you guys can see that on your screen, but it's at least a 4.5 to 1. You already have a good trading setup. So is this going to work for any stock on any time frame? Of course it is, because the trigger never changes. It's always going to be the same thing. So you already know that I made a bunch of money on Apple here just a couple of months ago, back in April of 2024. Fine, cool. But how can we use this and repeat the process for what's going on now? So now let's fast forward. Let's fast forward here. I took this January 23rd. Depending on when you watch this video, some time might have passed by, but the concepts are all the same. So 4-hour time frame, what do we got? Now we're using the 4-hour, and I've already built in the different demand levels. Does everyone see that? So we have a strong violent reaction off of here, strong violent reaction off of here. This was not surprising to me, this reaction, because I knew that if we were going to do stop loss hunting, which is a little bit more of an advanced concept, but generally speaking, this is not something that you see in trading books, but generally speaking, what market makers are looking for is the liquidity pool. So they're looking at level 2, or they're just looking to fill big orders. If they see that the institution has a huge order or going for a liquidity grab at 188, 189, what's going to happen is they're going to try to move that price action into that area to get those orders filled. That's why it is so critical that you understand you're not going to come into the demand level. Usually it doesn't happen this way. You hit that level perfectly, and just because you drew the pretty green bar there doesn't necessarily mean you're going to bounce off that level. You got to get out of that habit. You are going to take the trigger based off of the moving average, and that has everything to do with a volume. If you start seeing volume come in, the moving averages are going to pick that up, the EMAs or the SMAs. You can use them interchangeably. If you're going to use that particular trigger, if you want to just add an additional level of confirmation, that's going to be the volume bars. I'm going to tell you now from experience, just because you see an elevated candle here or a little bit of elevation on some volume, that is not sufficient confirmation for you to take 20, 30, 40, 50% of your portfolio and put it all on black or put it all on red. That is not what you want to do. All you want to be aware of is as you're coming into the demand level, remember, this is just one level of confirmation, right? There's different layers to this. You want to use the moving averages and the TTM to confirm the trigger. And then you want just that additional layer of, hey, is there some volume behind this or is there not volume behind this? That's how it is I use the volume bar. You're going to see how I use the volume profile here in just a second. But would I have taken this trade off of this level? No, probably not. Why wouldn't I have done that? Because I'm looking for 2 to 3 touches. I'm looking for the second higher low and then the third higher low. That's how I'm confirming that I do want to take the long. If I would have taken this trade, I'm not going to do it off the 4-hour, but I probably would do it off the 1-hour. So let's go back. Let's try to see if I can go all the way back there for that trade off of the one bottom. Let's go back. Here it is. So we're off of 199. Where would I confirm the entry on this trade using the TTM and using the moving averages? Some of you are already very clever and you can already pick this up. Sage, I see what you're saying. We have the one touch there. And now that I'm on the 1-hour time frame, I can confirm a higher low here, and then I can confirm maybe a third higher low here. Is it very strong and prominent on the higher time frames? No. But if you're a shorter time frame trader, it's kind of there. I'm not going to say it's not. But check out where we are overcoming the 8 and the 21. The 8 overpowered the 21, so your trigger on the long is literally 210. That's what it is. Are you going to fire on this trade on all cylinders? No. You're going to take regular risk. You're going to do 1, 2, maybe 3% of your portfolio. And then on top of that, what you're going to do is you're going to set the risk reward calculator. How do I know where I'm going to set my stop loss? I'm going to eradicate all of the doubt that you have ever for setting where your stop loss is. Your stop loss is dependent on where you set your profit target. I generally, as a rule of thumb, am going to set that at where the previous most recent resistance point was. Where was that for me? That's at 219. So if I'm looking at my risk reward calculator, let's pull that back a little bit. If that number is not at least 2 to 1, then what I'm going to do is I'm going to adjust my stop loss. If I start to see that we are below the 2 to 1 threshold, that's where I stop and say, okay, I'm not going any further lower. If I'm taking my entry here and I have something very similar to what you're seeing on your chart, if you want to trade a 1-to-1, you just better know that you have to have better than a 50% win rate in order for you to be profitable. But if you want to move up that stop loss and you want to be pretty stingy on this, that's okay. Because I'm like this. This is exactly how I trade. I'm going to move up that stop loss. And if you don't see, hey, Sage, I don't think we can really get up to 219. I'm just going to set that at 215 and I'm good with that 2 to 1 risk reward. Good for you, brother or sister. All good. It's all good. If you at least do this, right? If you watch the other risk reward videos, this is it. This is how you need to trade. So there's some elements to this. Where am I firing on the signal? First and foremost, I'm firing right here on the oscillator. So I have a signal when I'm crossing the zero cross line. So the way that the histogram works, at least the way that I interpret it, you have a zero line on the histogram. When you are here with all the orange bars pointed to the downside, you are in an oversold climate depending on what time frame you're using. As you are oscillating in the other direction, your signal comes in when you are crossing what we know as the zero cross line. That zero cross line is right here. You see where all the red and the green dots are? When you start crossing that line, you want to line that up with whatever your 8 to 21 is doing, depending on if it's crossing or not. If you have dissonance, if you have a signal on the TTM, but you do not have a confirming signal, as you guys can see here, there's not a confirming signal where the moving average, the 8, is overcoming the 21. There's no signal to take. There's literally no signal to take. If you are trading off of the 10-minute time frame, then it's different. You want to make sure that this is lining up with that cross. Those are my 2 confirmations for triggers. On top of that, I'm only using the volume as a layer of confirmation. This is not going to be the de facto decision-making factor. The de facto decision-making factor is that cross and some sort of oscillation. I have filled in the blank for you guys. RSI, MACD, if you want to use the TTM. If you want to use the RAF, which is something that I use on another platform, they're all some form of oscillation. You want to try to line that up with a moving average. You don't have to use the 8 and the 21. You can use the 9, you can use the 13. Just always use the same trigger. This way, your trading is systematic as opposed to all over the place, where you're hunting for a position and you don't really know what it is that you're doing. So notice, it never changes. Now let's actually go to the example where we're discussing why I took Apple where it is I took it. We're going to talk about the moving averages, but we're also going to introduce new moving averages, and we're also going to talk about the volume profile. So I'm adding to the overall pool of information. Hopefully I'm not losing you, because this gets complicated real quick. I'm going to add these additional elements, but I want to explain them thoroughly. If you are thinking about trading as an institutional trader, some of you might be institutional traders. Some of you have traded on the professional side of this. Some of you are not even using line charts. You're using footprint charts, or you're just using implied volatility and average true range. Some people don't use charts. I personally do, because if I know how to trade how millions of other traders are perceiving the market, I know how to exploit that. This is what this is about. I'm going to add the 200 EMA and also 200 SMA. Notice that they are not lined up perfectly. I am just using both of them because they are very well used indicators, specifically the 200-day moving average. If you want to use the 150, 120, 130, just understand the statistics behind using that particular moving average. Why do I use the 200? Because it is wildly used in the market. Generally speaking, the boomers, or the people that move the market, the people that are the institutional traders that are taking billions of dollars on shares per one particular stock or ETF, they're watching that 200. Check out the 200-day moving average. And as we're coming back down into that demand level, I really want this to come across incredibly clearly. We have the one demand level and then we have one below that. Just because we hit the demand level or we hit the 200-day moving average does not give you the confirmation to go butt wild on this trade, to put down $1 million and say, okay, we're going to be making money on this trade because Sage is all excited and he's yelling at us in this video and he's saying, cool, demand level hit, 200-day moving average hit, 200 SMA, EMA are hit. Now we're going to make some money. We're going to make it rain. No, that is not it whatsoever. You just want to be aware that if we are stop loss hunting or if we are hunting for any particular demand level, you have to always consider, okay, I have two elements or two layers, but is my confirmation there off of the daily time frame? If you want to argue confirmation, your confirmation for a buy is at 234. I'm going to argue that you gave up. You pretty much gave up. Just look at that. You gave up an 8% move. So you're going to use two time frames, okay? Now we're really getting complicated, but you're going to use two time frames in order for you to confirm, hey, I see the structure. I see where it is. Sage is saying where the demand level is. It looks like I have another demand level back down at $208. So he's saying to me, okay, I'm not going to take the first demand level, but just in case I start seeing a buy signal on the shorter time frames, I might want to take a bite there. Now you're starting to think like me. So we're going to go into the 30. And now we're going to start building a picture. Notice I drew a trend line here. The trend, well, actually, it's not even a trend line, so that's insignificant. But we have a double bottom off of 220. Take a guess where it is I took this. Let's remove the 200-day moving average because they're not going to help us off of the 30-minute or the 1-hour time frame. So let's remove that and let's remove that. Let's just keep this basic. Where do you think it is I took this trade? I took it at 220. Why do you think I took it at 220, right? It's very obvious. If you've been following along with all the examples, the ones that I talked about IWM, when I went over Adobe, when I went over Tesla, when I went over all of these examples, I'm taking it off of that trigger. So there's two of them. I'm going to give you a pro tip here. The reason why I like using real world examples is because in a textbook, they're going to say, hey, the TTM is going to line up with the moving average, that's going to line up with the MACD, that's going to line up with the RSI, that's going to line up with XY. It never ever is that way. I can tell you with absolute certainty that when you get a signal in the market, you're probably going to find in your career, if you take 10,000 or like I have 50,000 trades, if you've taken that many trades, you will find that you can count on both hands how many times the conditions were absolutely perfect. This is where people sometimes, myself included, we didn't understand that you got to practice this. You got to be able to identify, hey, this is good enough as a signal. It's never going to be perfect, but it seems like the winds are starting to line up here for my sales, and this is where I'm going to take the risk. That's exactly what I did on Apple. So let me outline this. We have a trigger here in pre-market, but you could have taken this trade at open as well. You have a double or a triple bottom. You can argue a triple bottom here. And then you started breaking out for pre-market, but you started seeing some movement off of 220, 223. This is where I fired the trade. When I'm going to take the trade, obviously I'm going to use the risk reward calculator on every single trade I take. What is the first most recent resistance area? Some of you are going to say, hey, I see it. It's at 225. You're right. You're absolutely right. I'm not going to argue that at all. I'm going to set my stop loss where this number is at least 2-to-1. So if I want to go a little bit lower, I want to go for a break of structure. Where do I have that? At the break of structure. If I want, or at least I had confidence when I was going to take this trade, I saw that 225 was resistance, but realistically, I'm going to be honest with you, I was going to take that up to 230. So now this trade is at 3.5-to-1. Let's move back here on the 1-hour time frame so you guys can get more context. That's my entry. Let's remove that, and let's put the risk reward calculator back on the chart. Notice that I outlined what my entry was, but not just because I took the trade. That's the entry every single time, every single chart, every time frame. It's the setup, man. This is the primary setup that I'm taking. I'm going to move that into that designated area and see how it is that they almost perfectly align. You want to be careful with this. You want to be careful with your anchoring or confirmational bias when you're seeing this, but you don't have the context of what the demand levels are on the higher time frames. I see this all the time. I used to make this mistake, and this is why I'm so passionate about explaining this, because I've lost so much money in doing exactly what I'm telling you not to do. You're not going to just take the trade off of the 30-minute time frame without you knowing what the demand levels are on the 1 hour, the 4 hour, or the daily time frame. I would highly discourage you from doing that. I would encourage you to at least know, if you're going to take it here, you probably want to know what the demand level is off of the 4 hour. You don't always have to use the 4 hour, but if you're going to take an entry off the 10, know at least what the 1 hour time frame structure is. If you're going to take a trade off of the 1 hour, at least know what the 4 hour time frame structure is. If you're going to do an entry off the 5-minute time frame, at least know what the 30-minute or the 1 hour time frame structure is going to be. You want to try to always know where potentially you can go for the trade, whether it's up or down. In this situation, I took a long. Let's go back there to the 1 hour time frame. I'm lining up pretty well on the TTM. Some of you are thinking, how does Sage know that we were going to start blasting off like this? I had no idea, not a single clue. What I do know are some things that are not so prominent on the chart. Remember pillar number 1, I have to go back to that. You got to know your statistics. You got to know your stocks. You have to know behavioral psychology. You have to know that Apple is a good quality stock, and if you buy it low enough, even though if you do hold on to the trade because now you're bag holding, that's okay. It means you can pull back another 5, 6, 7%, and you might want a dollar cost average into the trade. If you want to apply that methodology, that's fine. If you want to follow that, at least do that on good quality stocks. I wouldn't recommend you do that on pretty much anything else that's not at the top 25 stocks in the stock market. So how am I going to set the stop loss? This is what I've done. I actually took this trade the first time back down here. So I was stopped out on this trade. I got stopped out when we were starting breaking below my structure, and then I jumped back in the trade. That's exactly what happened on Apple. Literally, I took this trade twice. I've done this recently on Google too. I'm going through the same situation. I got out at a 3% loss, and then I took a break-even trade on Google for a second time. I'm going to re-enter the trade using all the principles that I'm discussing. So here, my TTM starts to fire. I don't know that it's going to go all the way up to 230. I have no idea if it's going to go all the way up to whatever it is, 240, 245. I don't know. But I'm thinking about this as literally a problem. How am I going to solve this problem? If I'm going to take the trade, what is my risk reward? If I'm going to trail my stop loss, what is my methodology and what is my system for trailing up the stop loss? I'm going to share with you what mine is and what you guys should be doing as well. Off of the 1 hour time frame, if I'm up 2% on the trade, then I'm going to be moving my stop loss at least to break even. We're only talking about shares. If you want to use an apples to orange comparison using shares and options, I'm going to tell you now the percentages are just 10x. If you have a 20% trade where you're moving up 20% on your Apple call, then you just want to move that stop loss to break even, especially if you're day trading. If that Apple call is now moving up to 50%, it is my recommendation that you at least trail the stop loss. Some of you are trailing by 10%. Keep doing that. Don't stop doing that just because I have a different number that I'm going to give you now. I usually trail by 20%. I'm okay with giving it that trail for that percentage amount because I want to give it some breathing room. If I would have trailed the stop loss by 5%, you can automatically set that with OCO orders. Don't worry if you don't know what that is right now. But if you are already trailing stop losses at a 5% trail, that's perfectly fine. That means that you have to be so pinpoint accurate on your entry that you have no room for mistake. I'm generally not that person. I'm making mistakes all the time. So I want to make sure that I'm giving myself some breathing room. So as soon as I get to the 20% mark, or in this case, the 2% mark on the shares, I'm moving it up to break even. If I start to go to 3% or 30% on options, then I'm moving it up to the 10%. I'm usually giving a 20% breathing room on any situation that I'm taking. Now, in this particular circumstance, I want to be clear and transparent that I did not trail my stop loss because I was confident that even though Apple, this really annoyed me when this started happening, even though Apple was selling off at 247 and then back down into my area, I moved up my stop loss to at least break even because I wanted to give myself some breathing room because I did take a substantial trade on this. So if I got stopped out on the trade, no harm, no foul. It means that I gave up some profit, right? We were up almost 10% on this trade. Yes, I gave up some profit, but I wanted to give it some breathing room. You don't have to do it like me. In this scenario, it is working in my favor. And recently, I did trail up my stop loss. I actually put my stop loss at 237. So 237 is right there. So I did trail up my stop loss. So now it is a free trade and a guaranteed profit trade. If I have a gap down on Apple, fine. It's just It's just the name of the game. But I am starting to move up and trailing up that stop loss. So that's how it is that I think about the trades that I'm taking. So now let's add one additional element to this, because we didn't even start talking about the volume profile. Let's get into that now. We have our demand level sets. You guys are already very well aware of where it is I'm taking my triggers. I'm using those moving averages. I haven't included the stack, but the stack, for some of you, you're using that as profit target areas as we're hitting the 50 or the 34-day moving average. If we start to hit that when you take a decent entry and you want to take it off that particular moving average, that's perfectly fine. That's another strategy as well. Let me share with you what that looks like off the 30-minute. I take that here at 220, and then I'm jumping. If I'm overcoming, and which I did, I overcame all of these moving averages here with the 8. If you want to take off the trade when you are coming into a resistance area, that's usually how I do it. If you want to do it off of the 34 or the 50-day moving average when you're overcoming that, because obviously this was a substantial move, that's perfectly fine as well. I would prefer, statistically speaking, because I've always back tested this, I would prefer to do it off of resistance point. I generally find that that's where I can get just a little bit more profit. That is more subjective opinion than anything else. But either of the two strategies are going to work so long as you adhere to the principle that we discuss constantly. This will not go away. I will repeat this 100 million times until you guys get it, because it is everything. Risk reward is going to be at the forefront of everything. That, and then you cascade lower into where the trigger levels are. Cool? Okay, so we have that. Now, how am I going to use the volume profile? I'm already pretty confident in taking the trade at 220, but as most of you, if you're a risk manager, if you work in cybersecurity, you know that there's always additional levels of securities that you're looking to apply in order to just stay away from some sort of disaster that you might incur for your company. It's the same thing with the volume profile. That's how it is I think about using it. So let me introduce that to you guys here. This might be a little bit funky looking. Some of you might be using the volume profile. The way that I use it, I want to show you guys my fine tuning on the volume profile so you guys can see exactly how I set it up. I have 50 columns, and then I have a separation between the bullish and the bearish candles, and it gives me just a little bit of insight into the liquidity. The way that I'm reading the volume profile is not very much different than how it is I'm interpreting supply and demand. When I took this trade, depending on where I want to anchor the volume profile, notice that the volume profile is going to change here in just a second. Depending on where I anchor the volume profile, this is going to change. It's going to tell me, hey, there was more shares that were bought or sold around this particular area. Cool? So the way that I interpret the volume profile is if we have what's known as a shelf, that shelf is going to tell me, hey, a lot of volume was traded into this area. I'm going to look at that as a demand level. Now, it's not always, remember, not always going to line up with the demand level that you drew out. Trading does not work that way. Trading is all about you putting as many pieces as you can together in order for you to tell a story. In this situation, I have a demand off of $227, right? So let's put that there. Some of you are going to say, hey, Sage, you're looking for layers of confirmation. You're saying that you want 2 off of your demand level. I'm probably going to go off of that double bottom, that higher low, the demand level that we had here, and then I'm going to take that signal off of 235. That's fine. If you say that to me during a session and I'm analyzing how it is you take your trades, that's perfectly fine because there's a system behind that. There's critical thinking behind that. What I would more so recommend is not taking so much your trades off of the daily time frame, but using the daily in conjunction with the 1 hour. So if I do that, notice now the volume profiles are a little bit different. Let's remove this and let's take off the pre-market moves. So notice that the volume profile is still pretty pronounced at 230. It really depends on where I'm anchoring this. If you're using an anchor weighted volume profile, I'm generally going to set it at the most recent low point. If I go back on my chart and I'm consistently seeing more and more low points, I want to go to at least the most recent one, depending on the time frame that I'm taking the entry. So notice how this coincides pretty well. We have a volume profile close to the demand level where I took this trade at, but I'm not using the volume profile as a definitive confirmation for a trigger. I'm only using it to see if it's going to line up with the demand level that I have predetermined based off of movement in a particular area. Let me explain this a little bit further. Am I going to consider the $228 to $230 zone as a demand level? You betcha I am. Why? Because we have two touches there. There is a higher low here. There's a higher low here. And then I have a signal approximately at $230. So I have several, right? Don't think that I only have the one signal off of the 1 hour time frame on Apple. That's not the case. I actually have two. I have one here, and I definitely have one there. Let's remove the 34 and remove the 50 real quick so you guys can see it better. There they are. They're definitely there. How am I using the volume profile? It is just going to outline to me where we could potentially start seeing where shares were traded at a high volume, where we might go for stop loss hunting. Stop loss hunting is basically where you have liquidity pool, where sometimes we're not looking at level 2, but market makers are seeing those large orders from institutions, and they're trying to move the price action into that zone. Some of you know this as order blocks. They're trying to move that into that zone so they can get that liquidity grab. This is why sometimes you see, hey, I traded into a demand level a couple times. I broke the demand level, and then the damn thing is starting now to move back in my direction. That's what's going on there, because there's no liquidity in that area. If there is liquidity a little bit lower, they will move that price action lower, and then they will get that liquidity grab and then start driving that price action into that direction. We went over this example with IWM. You will see it rampant in the market. That is, again, why I'm yelling at you and telling you that if you are going to use a demand level, make sure that you are taking the trigger off the moving averages, because the moving averages are pretty close to real time. They're not exactly 100% accurate and not infallible. Of course not. But they're pretty close. They're going to give you a good sense. As we are elevating with volume, we're starting to get a little bit of a move. The more you see that 8 overcoming the 21, usually that's a pretty strong signal. On top of that, you're using the TTM. And then just adding layer after layer. So we have 2 layers of triggers, and then we have 2 layers of supply and demand. You put that together, you can see how this is a recipe for adding a concrete confirmation of you taking the buy or the sell signal in the first place. This is a lot better than waking up and saying, I'm going to buy calls on Tesla or puts on Tesla just because I feel like it. There is so much more thought when it goes into making a system and understanding the system the way that I'm explaining it to you here. So on top of everything else, then you add this. Then you almost have a bulletproof system, seriously. So you do this here, and then you set the trade, and you take the trade every single time. You see that you have that particular trade firing a signal, then you take the trade off of the 1 hour or the 30-minute time frame. You want to confirm all the context off of the 4-hour time frame, and you do what it is that I did here on Apple. I took a 6-figure trade on Apple, and right now I'm trailing up the stop loss. I don't need to make a banger trade. I don't need Apple to go to 70, 80% in order for me to feel good about my trade. If I can move this up to maybe an 8, 10, maybe 15% gain on Apple, but I'm only willing to risk 3% of the overall position, I'm looking at good risk reward. That, in essence, is what you need to look for and think about for every trade that you take. Get away from the mindset of thinking every trade that I need to put on needs to be 150%. That is okay if you are setting good risk reward and if you are taking unbelievably good entries. That's perfectly fine. I'm not going to tell you to stop doing that. But apply the methodologies that we are discussing here. Make sure that if you are taking any trade going forward, you are knowing what your triggers are, knowing where to invalidate, and applying the risk reward always. Cool? This was a little bit on the longer side, but it is my hope, even after explaining this and repeating myself a couple times, you guys are starting to see the bigger picture of how we think about trading probabilistically and also thinking in systems as opposed to my sentiment or how I feel about the market. How you feel doesn't matter at all. The market doesn't care, and believe you me, the market will run you over every single time. Cool? That last example on Apple was really intense. I don't know if you guys ever hired a personal trainer that's really enthusiastic about their job, constantly yelling in your ear when you're trying to bench press 225 for the first time. Maybe ladies a little bit less than that. I was the personal trainer in that example. So as tradition, I'm going to give you the examples. I'm going to explain it technically as best as I possibly can, give you a whole bunch of information so you guys can think in the background as I'm explaining. But remember this, man. You knowing something intellectually and you actually applying it and executing on it, there is a world of difference, right? And trading is no different. Just because you know how to play the game or just because you know how to shoot a couple of basketballs doesn't necessarily mean that you're ready to play in the NBA. Trading is no different. Trading is literally playing chess with yourself and against 3 other people upside down underwater in the 4th dimension. I use that example and it's not exaggerated at all. Back when I started trading, there weren't so many variables. Liquidity was always something that we had, but now it seems like it's 10 times over because more people are trading. The barrier to entry is so much lower because retail trading is something that you can get into. You have a little bit of money, you have a couple $100, you can open up a Robinhood account, an IBKR account, and you can just already start trading. Liquidity is no issue. Now we have the crypto market. Now we're contingent upon what's going on with the Bank of Japan, what's going on with some of the things going on in Asia. So all these other variables, and not to mention what's going on Twitter. I mean, God forbid you get a tweet from the president and all of a sudden the market is starting to sink, right? We've all experienced this in the last 5 years. All those things need to be secondary considerations also for when you take a trade off the chart. Just because it's lining up perfectly, you have to always be skeptical. Be skeptical of every single trade that you take. I think when you set the expectation a little bit lower, this is just in my experience, you have a better time with trading. Don't always expect to hit a home run trade with every single position you will ever take. I think that you will be miserable if that is how you approach trading. The way that I think about it is, this is probably one of the best pieces of advice that I've ever gotten. If your trading setups or your system is not working and you're seeing, hey, I'm starting to accumulate a couple losses here. I have 5-10% drawdown on my account. One of the best strategies, just to make sure that we understand after all the technical analysis videos, is sitting in cash. Do not ever discount the fact that you not doing anything and you literally sitting in capital while the rest of the market seems like it's either taking off or selling off. If you do not see the setup that you know works well for you, the A+ setups or even the A- setups, do not start to take your B-, C+, or just regular C setups because you have no control over that. Sitting in cash is going to literally be one of the best strategies you can ever use as a trader. As things start to die down or as the temperature starts to cool off in the market, generally because implied volatility is going up and no one knows what the hell is going on anyway. Sitting in cash will be literally one of the best decisions that you ever make. I didn't understand this when I first started trading because I constantly wanted to catch every single little falling move that was going on. I wanted to short this. I wanted to be in that. And I was trying to catch too many falling knives or trying to do too many things at once. I would highly discourage you from doing that. Sitting in cash will be also, aside from everything else that we're learning, one of the most important things that you will learn how to do with your experience. That being said, we're done with this segment. I really hope that you guys enjoyed not just the information that we went over, but you actually learn how to identify something in the market. So with that, let's continue on to the next section, and I'll see you guys in the next couple of videos.